10 a.m. in Hong Kong and China. Markets are in the red this morning. And we are, of course, tracking the weakness with markets resuming their slide as Treasury yields tick up. Fears of escalating U.S. trade tensions continue to rattle investors. The U.S. tariff on China now standing at 145%. Vietnam and the U.S. have agreed to start formal trade talks. This as Chinese President Xi Jinping heads to Southeast Asia to bolster ties next week. And we are tracking shares of TSMC, the world's largest contract chip maker, posting a slight beat in quarterly sales ahead of its earnings next week. A very good morning at TGI Friday and welcome to the China Connection. I'm Emily Tan. A quick check on the markets across Asia, and we are tracking, of course, the weakness that, of course, started in the United States spilling over into the Asian trade as we wrap up what has been a very volatile week. And the biggest loser on the board here is the Nikkei 225, down 4.5%. We're seeing in Singapore losses in excess of 2%. The FTSE Bursa, the Philippines, as well as the Jakarta Composite, all down more than 1%. The outlier here is the TAIEX, better for 0.5%. It may have something to do with the earnings coming out from TSMC, the index heavyweight, helping to support the market. That is a look at what's happening in Asia. We saw a big sell-off on Wall Street overnight, giving up the gains from Wednesday's historic rally. The Dow sinking 1,000 points, down 2.5%. The S&P 500 down 3.5%. U.S. futures also tipping more downside when Wall Street reopens tonight. We're looking at the implied open, a decline of about 0.75% for the three major indices. Markets could still end the week higher, though, that after a massive rally yesterday, though they're still 6% lower month to date. The U.S. 30-year yield is climbing steadily in early Asian trade, crossing 4.9%. Its weekly gain is its biggest increase in at least 25 years. The 10-year also hovering around 4.5%. We're looking at 4.4543%. China bond yields have been choppy this week, but the 10-year yield mostly flat in week-to-date trade. Currently, the 10-year at 1.652%. We're seeing some big moves in the currency space as well. The dollar index touching the 100 mark. The Dixie currently at 100.32, and the Chinese yuan hitting an 18-year low against the dollar overnight as Beijing continues to let the currency weaken. Currently, we are tracking the CNY at 7.3168 and the offshore at 7.3215. Let's take a quick check on how the Greater China markets are faring this morning. It's looking a little bit mixed, but of course, we are tracking the 145% now. If you haven't been keeping track on a daily basis, we got an extra 20%. This is to include the fentanyl trafficking and the reciprocal duties, which stand at 125% being imposed by President Trump. So this is a further escalation, if you will, China being the main target that we have found out all this week. The embassy in Washington saying that China does not want to fight these wars, but it is not scared. If the U.S. wants to talk, it should let people see they are ready to treat others with equality, respect, and mutual benefit. Something else we are keeping an eye out is the de minimis exemption. That is no longer. Postal items less than $800 will be imposed with a 120% duty, or $100 per item, and 1 month later in June, that will increase to $200 per item. This as President Xi Jinping is meeting with the EU as well as ASEAN leaders. He's going to be seeing the Spanish Prime Minister today. Next week, he'll be going over to ASEAN. And we are tracking, of course, what's happening over in the TAIEX. So we've got the Taiwan markets better for 0.2%. As I mentioned, 145%, that is the number to watch. The Trump administration confirming that's the U.S. tariff rate on Chinese imports. China's kept the rate at 84%, but at this point, no telling what comes next. President Trump telling reporters overnight that he's still open to negotiating with Chinese President Xi Jinping.
Well, we'll see what happens with China. We would love to be able to work a deal. They've really taken advantage of our country for a long period of time. I think that we'll end up working out something that's very good for both countries. I look forward to it.
Big businesses buckling under these hefty price hikes. Amazon reportedly canceling hundreds of thousands of dollars worth of inventory orders from Chinese vendors, while the Chinese sellers that are left could very likely hike prices or quit the market themselves. According to Shenzhen's e-commerce association, Amazon CEO Andy Jassy telling CNBC they haven't seen a meaningful change in consumer behavior yet, and that as sellers look to pass on the cost of tariffs to consumers. Jassy says Amazon will do their best to keep prices low for customers.
When you have any threat of any kind of discontinuity, as a team, you have to think about what are the things you can do to help customers. And so we're doing everything we can to try and keep prices the way they've been for customers, as low as possible. And so we'll do things like we've done some strategic forward inventory buys to be able to get as many items as makes sense for customers at lower prices. And there are some cases where we have deals we were negotiated that weren't done, where we'll renegotiate terms to make it easier for customers to have lower prices. So we're going to do everything we can to keep prices as low as possible.
Are you seeing?
China, meanwhile, says it's restricting imports of Hollywood movies, and it may be one way of cutting off America's pop culture impact in China, but not really sure how much impact that'll have. China only imports about 10 big Hollywood movies a year. These movies reportedly only account for 5% of China's overall box office receipts, and they make up just a fraction of American movies' global box office revenue. China has meanwhile put itself on the map, not just with movies like Ne Zha 2, which smashed box office records earlier this year, but with other products that are further up the value chain and making a global splash with electric vehicles and autonomous driving, robotics, and AI. Taylor Ogan is a CEO at Snowball Capital, which invests heavily in Chinese tech, and joins me around the set here for a chat. Very good morning to you, Taylor. It's really good to see you. Now, it's been a very busy week, and I'm sure you, as well as many other people watching the markets, have been keeping track of the tariffs from the United States as it has increased on a daily basis. Up until today, we now have 145%, which includes the 20% for the fentanyl trafficking. What do you make of all that has happened this week, and what is the feeling on the ground? I know you're based in Shenzhen.
Yeah. So I think Trump 1.0 really signaled to a lot of Chinese businesses that they were in the crosshairs. And so they shifted during, since then. I think people don't talk about that enough. They anticipated, especially when Trump won again, that this could happen, and this could happen early. And so their businesses have shifted completely 180 from where they were in Trump 1.0. So they are not actually as concerned. It might as well be 500%. A lot of them really have transformed their business with respect to more Western exposure.
All right, so if it doesn't make as much difference this time because they have learned from Trump 1.0, what would China's move, what is their next move? Because they say they are open to negotiations so long as they are treated with respect.
What they will be negotiating does not really impact China's, at least, advanced technology business. So with respect to electric vehicles, I mean, there was a reason that even with a much smaller tariff, Chinese EVs did not sell in the U.S. They were not even talking about selling in the U.S. Robotics. China now has over half of the world's robotic installations. I think in the last 5 years, this is like the biggest turning point for China. Their factories are nearly completely automated now. They don't rely as much on human labor. Whereas in the U.S., nothing really has changed in the last 5 years that dramatically. So we're looking at two completely different environments. I think what will be negotiated, at least on the Chinese side, is less important.
Well, we got a chance to speak to Stephen Roach yesterday. He from Yale University as a professor there, and talking about the reaction that caused President Trump to what he says flinch, and of course then pull back, dial back some of the tariffs on the rest of the world. Let's listen in on what he had to say first.
There is always the nuclear option with the China's Treasury holdings, doesn't necessarily mean, a wholesale fire sale of Chinese treasury holdings, but it certainly could start out with China being notably absent at upcoming treasury auctions. And that in and of itself would be a major signal of more pressure to come.
So treasuries or even a potential depreciation of the currency, these are some of the options that the market is chattering about in form of one way that China could make itself heard. Does that make sense to you? How do you see it?
I think in 3 years, we will look back on what the focus is today and laugh. It's such a dramatic shift to technology. We should be screaming about EVs, about batteries. I mean, I'm an American. I want America to succeed. There's no plan for sourcing batteries. There's no politician is talking about incorporating robotics in factories. Like, these are really fundamental things that America needs, and it better not cut itself off from China, because it really needs China. Now that China is trending more ship self-sufficient, the few levers that the U.S. government has with respect to these advanced technologies, they're running out. I mean, really, it is dried up. China is self-sufficient nearly completely now.
Now, the things that you're talking about are all part of China's Made in China 2025, which was a 10-year plan to boost its self-reliance, boost innovation. So it's done really well and ticked most of the boxes, especially the likes of electric vehicles, renewable energy sources, and targets. In terms of further development or these tariffs, do you think that it will have any impact on the further development and advancement of China?
So Made in China 2025, as you said, was really successful. We are in 2025. We can now look back on what China has achieved and not achieved. The one thing that they came short on was agriculture. And I do think that this is still potentially a risk, especially with bilateral relations. Agriculture is really important to China, and it's one of the things that technology isn't going to completely transform overnight. So yeah, I think that China probably in these negotiations will be focused on agriculture.
In terms of agriculture, I thought that China, before this whole move into technology, AI, they were farmers. So how could they be lagging in this regard?
I know, it does surprise me too. If you look at a farm in China today, a lot of them have drones for spraying various chemicals. They kind of skipped the having airplanes spray pesticides. It's just like the smartphone. They skipped laptops. They went straight to smartphones. And so I think that will be the future of agriculture in China, incorporating robotics and drones, but they're just not quite there yet. And I think it was a really ambitious target that they set 10 years ago. But I do think that they're going to eventually catch up to their goals.
Can we talk a little bit about what we're seeing in the markets, the market reaction? Of course, there's been a lot of volatility this week with all the different pronouncements coming through from the White House. In terms of the Chinese markets, the Chinese-U.S. equity valuation gaps, of course, there's been huge falls and huge increases in the market. This where does that stand right now?
It's messy, I'll tell you. When companies like Meituan tumble 14% on this news, it doesn't make sense. Like, there's no part of Meituan that, nothing in their supply chain, even making their drones for the drone delivery, nothing comes from the U.S. They have no business in the U.S. So these kinds of sell-offs, it kind of shows how misunderstood China still is by investors. I think that it will catch up. I think right now there is so much uncertainty in the United States. I think that's always been one of the biggest reasons to discount a lot of Chinese names. And if we're seeing that in U.S. companies now by the U.S. government, I mean, that is more unstable than the Chinese government. If you really take a macro perspective at it, China had this Made in China 2025 initiative. They have not deviated from that one bit. Like, that was their whole thing. And look where they are. Like, I think that this is why economists never nail China right. They keep missing it. And this, I think, people are really about to miss. Like, we're at the brink of the hockey stick curve. And it's really exciting. I wish that the U.S. was taking this more seriously. You know, we shouldn't be looking at tariffs on a daily basis, right? So, yeah, it clearly, you know, we're talking about a guy who had concepts of a plan. Who knows where he's going next? But it's clear where China is headed.
Okay, and if we are on the brink of that hockey stick curve, what are your top conviction calls?
Electric vehicles is an obvious one. I mean, BYD I think it could be the most valuable company in the world. You look at drone delivery, these things that, like, you have to come to China to see this. You can see promo videos. They'll talk about it on their, you know, investor calls. But like that, I get my coffee delivered by drone. Like, that's actually happening. In the city in which I live, 80% of new vehicles sold last month were electric. That is crazy, right? So there are some very obvious companies that most people probably have heard of that I think a lot of investors will start piling in. I expect to see a lot more investor and analyst trips to China because that's completely dried up. We have the Shanghai Auto Show, which definitely brings a lot of foreign faces to China. But I hope that those investors and analysts leave their hotel rooms and the auto show convention center and go out and actually see this is happening. This is, you know, China's very different than it was a few years ago. And I talk to investors in the US and around the world constantly about how they came to China like 5 years ago, and they think they understand it. You don't understand it. I don't recognize China from 5 years ago. So it's constantly evolving. There are some other companies that I think will be really exciting if they go public. I mean, a company like DJI, if and when they go public or one of their spin-offs goes public, investors that will probably be the biggest IPO in Chinese history. So you still have some of the darlings that are private. I'm not saying there's going to be a rush into IPOs or of IPOs, but it's definitely, people should be focused on the private companies just as much because they're coming and they're redirecting industries as we know them.
Do you think that these IPOs, would they go to the Hong Kong market or would they go to the U.S. market?
6 months ago, they were talking about the U.S. market. Absolutely no one is talking about the U.S. market. I mean, for good reason, right? Like, the U.S. government just said it's not out of the cards if they are going to completely delist all Chinese companies listed in the U.S. Who would, in their right minds, want to list in the U.S., right? I mean, now it's a question of, do they list in Hong Kong or Shanghai or Shenzhen?
So we're going to watch out for that. And Taylor, thank you very much for coming to speak with us today.
Thanks for having me. Congratulations on your new show.
Thank you so much for being on the China Connection. We've been speaking with Taylor Ogan from Snowball Capital. And as we head into a break, we want to show you the action in the commodity space. Spot gold hitting at another record high overnight, plus oil prices extending losses. WTI now below the $60 handle. We'll take a quick break here. Back right after this.